All right, let's get more on that. We're joined by Jonathan Sheridan from FIG Securities, and probably worth walking through exactly what Treasuries did in response to that, and therefore how they were reading Yellen's comments overnight.
Yeah, good morning. I think good to have those supportive comments. I think the central bankers around the world have a lot more data than most people about their economies, so it's interesting to say that for Yellen to say that she's seeing continued weakness in the labour market. Obviously, those data points that come out, the non-farm payrolls coming out on Friday night, are key to the market's view on what the stimulus might look like going forward. So when she comes out and says she sees continuing weakness, and particularly since we've had all the weather-affected data out of the States, I think that they're probably looking through that, and it's a sign that stimulus will be here with us for a while yet.
There wasn't much of a jump up in the longer end yields, though, was there?
No, not at all. The US 10-year was essentially flat overnight. So I think, again, it's consistent. It's a consistent message. There's plenty of rhetoric around rates will be lower for longer. We'll maintain the stimulus as long as required. It's about getting the economy back on track, and the labour market's obviously a key building block to that recovery.
This essentially was shorthand for saying risk remains on. Go out and buy equities.
Yeah, I mean that's part of the. I think that's part of the problem, to be honest. Is these vast amounts of stimulus are naturally buoying risk markets. Is
it getting too micro analysis to understand? We just played a moment ago those remarks from Yellen, and two words jumped out at me, which are scars remain. Are there some scars that simply never heal, i.e. the stimulus never goes away?
I think that's a very real concern. There was an interesting piece of commentary that I read this morning, which was talking about the neutral rate in the economy being the rate of cash rates overnight that neither stimulate nor restrict the economy in growing. So perhaps we're seeing a move down in what that rate might be. Historically, I suppose in Australia it's been at the sort of 4% level. Maybe it's coming down now to maybe a 3% level. So like you said, those scars might remain for some time. I mean, interestingly, the two words that I picked out of her statement were Great Recession. I think, we talk about the Great Depression from, the late 20s, early 30s of the last century, and for this to be compared to that with the decade-long recovery that it took after that, I think is very interesting.
Have you got a view about the policy levers now that the ECB across the Atlantic might employ, just given what is looking to be a pretty downward spiral into deflation?
Yeah, that's right. Deflation is, I think, a very real risk in the minds of many in the EU. Significant this week that the head of the Bundesbank basically came out, almost changed his tune completely in support of Draghi and what the ECB are trying to do in terms of stimulating the Eurozone growth. The good thing about that is if inflation is basically non-existent, then they can go ahead and stimulate to their heart's content, because inflation is the real policy concern if you are pushing lots of money into economies.
Maybe he had seen the labour market report out of Germany tonight and was sounding off ahead of it. Who knows? We'll get more detail tonight. Thank you so much for joining us.
Thank you.
I'm Jonathan Sheridan from FIG.